Today we're going to be talking about how you can take money out of your limited company business. We're going to talk about the 5 different ways you can withdraw the funds, and we're going to talk about how that impacts 3 different types of taxes. So therefore we hope to give you better informed so that you can choose how to take the money out, understand the impact on the tax, directly relevant to your personal circumstances, and not just following one formula that may or may not apply to you.
Welcome back to the Basics of Business channel, everybody. And as Neil, you talked about there's 5 different ways to get money out of your limited company. You've been in business advisor for 30 odd years now. Short and sharp, the 5 different ways are...
Yeah, so the 5 ways are: take a salary, take a dividend, reimburse yourself for any out-of-pocket expenses, take a loan, or pay it into a pension fund. I can't think of any others. Those are the 5.
You can't just take the money and then it's all over.
Well, stealing, I suppose, would be a sixth option.
Now this obviously, when you're an employee, which obviously most people have been at some point in their career, you don't need to worry about all these things. You get your salary in, your employer deals with everything in terms of paying your tax. However, there are advantages and disadvantages by doing it yourself, etc. But what would you say as in the 3 taxes that then impact your potential decision on how you take that combination of those 5 and how you use them?
Yeah, well, you just mentioned that if you were an employee, your employer sorts it out. But what they're sorting out under PAYE, pay as you earn, is they're sorting out your income tax, and they're sorting out your national insurance, and they're sorting out their national insurance. So there's both employee and employer's national insurance. So 2 of the 3 taxes are involved when you're just a straightforward employee. The extra tax to consider when it's your own company is what impact will there be on the corporation tax, which is the company's own tax bill on what it's earning or making a profit on.
So, I mean, why don't I just being an employee, I've set up my business, created a limited company. Why don't I just do what I did before in terms of just pay myself a salary, say it was the same salary for sake of argument as I had when I was employed? Why don't I just do that, just to keep things simple?
Well, in terms of just to keep things simple, there is no reason why you can't do that. But there might be more tax efficient ways to take the money out. So, one of the things that when I was an accountant, one of the things is you were looking at, we used to call them tax efficient profit extraction strategies. And that was saying, well, actually, you're allowed at the moment to have £2,000 a year, dropping to £1,000 a year, dropping to £500 a year of dividends tax free. So there's sort of like, well, if I'm going to be taking a salary which I'm going to pay tax on and tax on, I can take a dividend for £1,000 and pay no tax on it. So I'll drop my salary by £1,000, take the dividend. I'm going to be better off.
Yeah.
Also, there's no national insurance on dividends. So very often you'll see the things are, well, you take a salary of 12.5 grand because there's hardly any national insurance gets paid, and everything else gets taken as a dividend because although there's different tax rates on dividends, overall you'll be better off at a starting point of taking dividends instead of salary if you're earning your income from that company. But there's a lot of other things that come into play. So a lot of those sort of one size fits all, do it like that, is where it is the sort of contractor type thing, and there's a whole industry built up for the sort of IT contractors where very often it was the banks. They wouldn't employ people direct because they didn't want the headcount, so they forced people to use agencies or limited companies, and a whole industry split came up and said, hey, you're an IT contractor earning decent money, we can structure how you pay yourself in a very tax efficient way. But even that, not every contractor would have exactly the same personal circumstances to decide whether it was the most tax efficient thing for them. And so going back, we're talking salaries. If you take a salary, the company, your employer, your company has to deduct tax and national insurance under the rules of the PAYE schemes. It has to pay additional national insurance, but that cost or that payment is a cost to the company because it's employing a staff member. So it will reduce the amount of corporation tax that the company has to pay. Whereas if you take it as a dividend is a distribution of the profits after tax. So the corporation tax bill will be higher, but you'll have saved income tax and national insurance. So it is very complicated. If you want them to be making pension provision, again, it's a very tax efficient way to do it with the company making pension
and that's a
provisions.
great example of where personal circumstances can be different. So in terms of me, UK, I'm going to be staying in the UK, I'm going to want to think about pension contributions or whatever. If you're a visitor to the UK, say, I don't know, from Australia, New Zealand, etc., you're here for 2 or 3 years, that's not...
Yeah, you're probably just wanting to maximise the money in your pocket at the end of every month because you're having that experience of, coming to Europe for 2 or 3 years, as a lot of people from there do. And so therefore you've got completely different requirements and expectations and whatever. And I think the other thing, I'm saying there's a whole industry for these sort of contractors. And again, you would have a different view if you were actually building a business. Because, again, a lot of the examples are, all of the company's profits are being paid to you because the company is actually just this middle thing that the bank or whoever has forced you to create so that you can get paid. The Inland Revenue have, got loads of special legislation known as IR35 that targets those sorts of things to try and avoid or prevent the contractor getting the tax advantages that I've just talked about. So, well, if the company didn't exist, would you be an employee of the bank? Therefore, you should be paying the same amount of tax. The company should be paying the same amount of tax and national insurance as if you were the employee. And so there's a lot of complex sort of anti-avoidance legislation around that. So you do need to take advice. But I think the other thing that we're wanting to get across here is it's not just taking advice to avoid the IR35 things. Because again, if you've set up a genuine business and you're trying to build a business and you've got to pay yourself, then some of those same rules will apply. But also, you're going to be wanting to think about, well, how much money do I need to leave in the business to reinvest in the business because I'm trying to grow something? And likewise, if you're trying to grow a business, potentially the value of the company at exit is going to be more important to you than the income that you're taking out in the years leading up to that. So, that would be another thing to bear in mind. And, one of the other areas as well is where, if this is not your only source of income, so if it's a side hustle, you've got a job and you've set something up on the side, or you're running them both at the same time as you're starting out before making the leap to become fully self-employed or running the business, then again, at that point, you've already using various allowances in your employment. So your decisions about how you might take any profits out of the side hustle would be different than if you only had, if it wasn't a side hustle, it was now a full-on hustle.
And in tax efficiency, I know there's a lot of discussions of, these are legitimate legal ways to take money out of the business, and just your personal circumstances will dictate the sort of the levels that you use across basically which levers you pull almost.
Yeah, I saw one of the examples from someone else saying, pay yourself this small salary and pay everything else into your pension. That's the least amount of tax. Absolutely. 100% you can't deny you would pay the least amount of tax if you did that. However, you can't take the money that's in your pension. So you've got to live on the 12,500 a year. Yes, you might be putting 50,000 a year into your pension, but can you survive until you're 55, 60 or whatever it is when you're going to draw that pension? So, there's an old saying, don't let the tax tail wag the dog. And that does apply. There's no, paying the least amount of tax may just not be practical.
No, exactly. Because people still rent, pay mortgages to pay. You've still got to live on it, and that's where you've got to factor. As I say, those are the 5 ways, the 3 taxes that are involved, and I think this is probably, as I say, whether that's 70, 80% will end up at the same answer. However, they might do it for different reasons.
But one of the other things you mentioned just a moment ago, people have got rents and mortgages to pay. But actually, if you are looking to get a mortgage, how you're drawing the money out of your company can impact how a lender would view your position and whether they would, what sort of mortgage, what rate you would be charged, or whether you'll get one at all. So again, that can have a big impact on how you might decide to take the money out of the company for something that's got nothing to do with tax or even day-to-day living. It's about making sure you can present the best case to a lender in due course.
Yes. And I know it sounds silly, but you have to have money in the company in order to do this. And tax efficiency is all great. However, if there's not a lot of sales and a lot of money coming in, your options are pretty limited. If you're not making a big amount of profit, that dividend aspect really goes by the wayside.
People get obsessed about the amount of tax and the tax rates, but in a way, having tax to pay it should be a nice problem to have, because it means you're making money and you've got a decent income, or you've made a capital gain, or whatever it is, and therefore you've now got to pay some tax on it.
Yeah. And and around, if you do, there are things like nice around expenses and things like that, trivial benefits and £50 vouchers or whatever that you can take out per director. I think it's up to 300.
Yeah, absolutely.
We've got another video on do you really need an accountant? This is probably a good example of where having knowledge of those 5, a basic knowledge in the 3 taxes is great. However, getting into the weeds, your accountant will be able to apply those 3 to the 5.
Yeah, and
the best out of it for you.
Absolutely. We're saying there's 3 taxes. We're saying there's income tax, there's national insurance, and there's corporation tax. But even within that, you can break that down and say, well, income tax, there's PAYE tax, there's dividend tax, and then there's tax on benefits in kind. So even that has this 3 possible ways that income tax could be or could impact you or apply to you. On corporation tax, yes, there's mainstream corporation tax, which is just the company's made this much profit, a percentage of it has to get paid to the taxman. But there's another thing called a Section 455 tax charge, which I won't go into, but technically it isn't a tax. Yeah. But if you take a director's loan, then the company has to pay something like 33.75% of whatever you've borrowed to the taxman as a tax charge. When you repay the loan, they'll get the tax back. So it's not a tax that's lost forever, but again, that's something I would bracket it in the corporation tax pot, because it's the company that actually has to physically make the payment, but it's not actually a tax. It's a tax charge which will come back as and when the loan is repaid. And then national insurance, as we said, there's 2 types of national insurance. There's employees' national insurance and employers' national insurance. And then again, can be national insurance on benefits in kind as well.
Yeah. So as you say, people they're sort of flashing how I'll save tax, etc. It is potentially true, but the UK tax system, I think, it is phenomenally complicated from that point. And while those are the 5 ways and the 3 taxes are the basics, there's an incredible amount of detail underneath that we would argue is not worth your time getting to know and understanding. Just in terms of step, I'd say the step is knowing how much money you need, etc., and then taking that to an accountant with your business numbers, and then they will work out the best bit for you.
Yeah, I think if it would be worth, as you're starting out and you started making money and you're going to start paying yourself, it's got to be worth having at least one meeting with an accountant who understands what you're doing, can say to you, this would be the consequences of if you structure it like this. And as I say, having the lowest tax liability may or may not be the overall driver. There might be other things you need to take into account. And so that's why having that, then that might do you for, who knows, years. You just follow that same structure. Every year there's at least one budget. There can be change of government, so the budgets can be very, very different. So it might be once a year. It might be worth a quick chat with an accountant, a tax advisor, and just say, do I need to change what I'm doing? That your own circumstances would change. So should I change how I structured, how I'm taking, how I'm remunerating myself?
So, and on that basis, the numbers again will change coming up in April 2024. So please give us a subscribe and a like to this video, because we're going to do a follow-up on this video where we're going to run through a number of scenarios highlighting these points across the 5 different ways and the three taxes and how they impact across a number of scenarios. So we're going to do that in April when the new tax numbers come out. As ever, we wish you every success with your business journey. Thanks for watching, and press that like button, as you say, if you like this video, and we'll see you in another one shortly.